First Resources just posted a 75% profit rebound, strong EBITDA margins, and trades at just 7.4 times earnings, while slashing debt to nearly debt-free levels. But with palm oil prices still volatile, is this a turnaround moment for EB5? Let's break it all down. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. First Resources, SGX, EB5, is one of the largest palm oil producers in Southeast Asia, with over 400,000 hectares of plantation land and fully integrated upstream to downstream operations. It supplies refined and crude palm oil, oleochemicals, and biomass energy, and operates across Indonesia, China, and the international export market. First Resources delivered strong Q4 2024 results. Revenue rose 6% to $1.04 billion, while net profit surged 69% to $245.8 million. EBITDA jumped 49% to $428 million, with solid EBIT margin of 33% and a net margin of 23.7%, showing high operational efficiency. Free cash flow remained positive, and net debt dropped 18% to $356 million. The debt-to-equity ratio is just 18%, with net gearing below 0.2 times, reflecting a healthy balance sheet. With EPS at 16 cents and a share price of $1.49, First Resources looks fundamentally sound and undervalued. First Resources remains heavily upstream focused, with plantations and palm oil mills accounting for around 89% of total revenue, an impressive $923.5 million. Upstream volumes rose sharply, with fresh fruit bun production up 12.4% and crude palm oil and kernel output up 14.9%, benefiting from favorable weather and replanting. Downstream, which refines crude into higher value products, saw a small drop in volume due to export restrictions, but margins remained stable thanks to strong cost controls and operational efficiency. This high level of integration, from plantations to processing, continues to underpin First Resources' profitability and efficiency across the value chain. First Resources is trading at just 7.4 times trailing earnings and under 5 times EV/EBITDA, making it one of the most attractively valued plantation stocks on the SGX. With a 6.2% dividend yield, net profit margins near 24%, and a debt-to-equity ratio of just 18%, it offers a rare combination of strong cash flow, low risk, and high income. Its ROE of nearly 18% justifies a price-to-book of 1.3 times. Solid value for a business this profitable. Over the past 5 years, First Resources has weathered commodity cycles but emerged stronger. Revenue and EBITDA dipped in 2022 but rebounded by 2023 to 2024 to over $1 billion and $428 million respectively. Net profit peaked in 2021 at $325 million before normalizing around $246 million, a sign of stable earnings. Meanwhile, its share price has fallen from $2.20 in 2021 to $1.49 today, even as fundamentals improved. In short, profits and cash flow are bouncing back, but the stock hasn't yet reflected that recovery, possibly presenting a value opportunity. First Resources has several tailwinds at play: stronger domestic demand from Indonesia's biodiesel mandates, rising consumption from India and China, and enhanced yields thanks to favorable La Nina weather. These support higher prices and volumes. Its high margins, robust ROE, and 6% dividend reflect a resilient and profitable model. However, it faces notable risks. Palm oil price volatility driven by export bans and competition from soy and sunflower oil, geo-export policy shifts in Indonesia, and EU deforestation regulations that could limit market access. Finally, as a plantation business, it's under ESG scrutiny over deforestation and labor practices. Overall, while upside is supported by structural demand, macro policy and sustainability issues demand careful monitoring. Analysts remain cautiously optimistic on First Resources. RHB rates at a buy at $1.70, while Maybank is more conservative, holding at $1.69. Fintel's average target sits higher at 1 Singapore dollar and 88 cents, suggesting up to 26% upside from the current price of 1 Singapore dollar and 49 cents. With strong earnings and high dividend yield, many see First Resources as a stable value play, but short-term gains depend on palm oil price stability. First Resources offers strong cash flow, rising margins, a clean balance sheet, and a 6% yield, all at a low valuation. Yes, there are risks like commodity volatility and regulatory changes. But if palm oil prices hold steady, the upside looks compelling. Is this the time to accumulate? Let me know in the comments. And don't forget to subscribe, and follow Durian Finance for more SGX deep dives.